In 2014, Bitcoin didn't just crash. It nearly lost the entire system that allowed it to function. At the time, one exchange handled the majority of all Bitcoin trades worldwide. For many people, that exchange was Mt. Gox. Then, without warning, withdrawals froze, balances vanished, and hundreds of thousands of Bitcoins were suddenly gone. This wasn't just a market crash. It was a moment that forced a brutal question. If Bitcoin's biggest exchange can fail, can Bitcoin survive it all? This is the story of the Mt. Gox collapse and why Bitcoin lived through its first real stress test. What Mt. Gox was. To truly understand the Mt. Gox collapse, you have to understand just how fragile the early Bitcoin ecosystem really was. In early 2010, Bitcoin wasn't regulated, insured, or protected. There were no standards for custody, no industry best practices, no clear legal framework. Most people didn't even understand how Bitcoin worked. They didn't know what private keys were. They didn't understand cold storage. And they certainly didn't expect exchanges to fail. Mt. Gox became dominant not because it was exceptional, but because it was early. And in early Bitcoin, being first was enough. By 2013, Mt. Gox handled over 70% of global Bitcoin trading volume. For many users, owning Bitcoin meant owning a Mt. Gox account. This created a dangerous illusion. People believed Bitcoin was centralized because their experience of Bitcoin was centralized. Mt. Gox held customer funds. Mt. Gox processed withdrawals. Mt. Gox controlled access. But internally, Mt. Gox was chaotic. Wallet management was sloppy. Accounting systems were outdated. Security decisions were reactive, not proactive. Bitcoin was designed to eliminate trust. Mt. Gox required blind trust. And that contradiction grew more dangerous as Bitcoin's price and importance increased. The collapse. The collapse didn't happen overnight. It unfolded slowly, quietly, and invisibly. For years, hackers exploited Mt. Gox's weak internal controls. Coins were siphoned out in small amounts. Losses were masked by poor bookkeeping. By the time anyone noticed, the damage was catastrophic. When withdrawals began slowing in late 2013, users were confused but patient. Bitcoin transactions were still poorly understood. Delays didn't immediately raise alarms. Then withdrawals stopped entirely. Mt. Gox blamed Bitcoin itself, claiming a technical flaw called transaction malleability made withdrawals unsafe. That explanation spread fast, and it did real damage. Because for the first time, Bitcoin, not an exchange, was being blamed for failure. Behind closed doors, executives knew the truth. The coins weren't delayed. They were gone. In February 2014, Mt. Gox suspended trading. Soon after, it filed for bankruptcy. Over 850,000 Bitcoins had vanished. Customers were locked out. Balances were frozen. Years of savings disappeared overnight, and panic became global. Market reaction. The market reaction was brutal. Bitcoin's price collapsed nearly 80%. Trading volume evaporated. Confidence was shattered. But the psychological damage was even worse. Governments pointed to Mt. Gox as proof Bitcoin was unsafe. Banks refused to touch crypto companies. Investors fled. The phrase "Bitcoin is dead" became a meme, repeated again and again. Developers went silent. Startups shut down. The ecosystem entered what many now call Bitcoin's first dark age. And yet something unexpected happened. Bitcoin didn't stop. Blocks kept being mined. Transactions kept confirming. The network remained stable. Despite the collapse of its largest exchange, Bitcoin itself showed no signs of failure. This forced a realization that changed crypto forever. Bitcoin didn't fail. A company failed. Why Bitcoin didn't die. When Mt. Gox collapsed, many people thought Bitcoin would die with it. News headlines declared the end. Critics laughed and said, "This proves Bitcoin was a mistake." But something very important happened instead. Mt. Gox failed because it was centralized. Too much power was in one place. One company. One point of failure. Bitcoin survived because it was built to avoid exactly that. No matter how big Mt. Gox became, it never controlled Bitcoin itself. It didn't control the Bitcoin protocol. It didn't control the network. It didn't control mining. It didn't control consensus. Mt. Gox was just a service sitting on top of Bitcoin, not Bitcoin. The rules of Bitcoin were enforced by thousands of independent computers called nodes spread across the world. No CEO could change them. No exchange could rewrite them. No government could shut them all down. That separation was everything. The collapse of Mt. Gox didn't expose a flaw in Bitcoin's code. It exposed the weakest part of the system, centralized intermediaries that asked users to trust them. And once that weakness was revealed, the ecosystem changed. People stopped leaving coins on exchanges. Cold storage became normal. Hardware wallets became popular. Exchanges were forced to prove they actually held the Bitcoin they claimed. Proof of reserves became a demand, not a bonus. Security audits became expected, not optional. Most importantly, users learned the hardest lesson crypto has ever taught. Not your keys, not your coins. If you don't control the private keys, you don't truly own the Bitcoin. You're just trusting someone else to hold it for you. That lesson was painful. It cost people money. It cost people trust. But it also made Bitcoin stronger. The collapse of Mt. Gox didn't weaken Bitcoin. It removed a dangerous illusion. It forced the community to grow up. It hardened the system. Bitcoin didn't survive because it was lucky. It survived because it was designed to survive. And that difference changed everything. Mt. Gox failed, and it failed spectacularly. Millions were lost. Trust was shattered. And for a moment, it looked like Bitcoin itself might collapse under the weight of that disaster. But Bitcoin did not fail. And that distinction matters more today than ever before. Because the real risk in crypto has never been the protocol itself. It has always been the layers built on top of it. Exchanges can fail. Companies can lie. Founders can disappear. Custodians can freeze accounts or vanish overnight. But a decentralized protocol doesn't panic. It doesn't lie. It doesn't make promises, and it simply keeps running. Bitcoin doesn't care who believes in it. It doesn't care who sells. It doesn't care who betrays the system. As long as there are nodes enforcing the rules, as long as miners compete honestly, as long as users hold their own keys, Bitcoin survives. The collapse of Mt. Gox wasn't the end of Bitcoin. It was the moment Bitcoin proved what it really was. It survived betrayal. It survived fear. It survived the largest failure in its early history. That was Bitcoin's first real stress test. And it passed. Every bull run after that, every crash, every debate about regulation, custody, and trust, all of it was shaped by the lessons learned from Mt. Gox. Mt. Gox showed the world what happens when power is centralized. Bitcoin showed the world what happens when power is distributed. Mt. Gox is gone. Bitcoin is still here. And that is the difference between a company and a protocol. If this story helped you understand Bitcoin on a deeper level, make sure to like the video. It really helps the channel. Subscribe to Daily CoinWire for more deep dives into crypto history, technology, and the lessons most people miss. And comment below, do you think the crypto world has truly learned from Mt. Gox? Or are we repeating the same mistakes again? Thanks for watching. Stay curious, stay informed.